Hello friends, welcome to the second video for the topic IFRS. Hope you have already revised the first part of the topic, which includes the concept, the introductory part of the concept, after that the need and a few basic criteria such as like what is the structure, what are the frameworks relating to IFRS. Today we are going to see two contents into this IFRS. First will be the various provisions of the International Financial Reporting Standards, that is IFRS in India, most important. And then we'll see status of such provisions, like provisions are there which are made applicable to the organizations to which such IFRS is mandatory to be followed and how they are followed, like what's the status of such provisions. Let's see in detail. First is the accounting policy, accounting estimate and the errors. Initially we need to know first thing regarding the accounting policy, then whenever we change any accounting policy then it has to be made into the notice, or it should be brought into the notice of the concerned people. So typically here in the IFRS it's very much important for an entity to make such new IFRS applicable which is being issued but not made effective at that particular time or date, and then this fact has to be disclosed, which is going to give some changes in the estimates, some important information to the stakeholders, to the researchers on the financial statements, to everyone. So whatever are the changes in the accounting policy due to such adoption of IFRS has to be first of all informed and brought to the notice. Further, IFRS permits a change in accounting policy. It's not that IFRS is saying you stick to whatever your existing policy is and follow me. That cannot happen because it may not always be the same scenario that whatever is generally adopted in the international standard is the same thing what a country may be adopting it right from earlier. So if required for the adoption of IFRS, an additional or the accounting policies which are not earlier followed shall be adopted, and such changes should be brought into the notice, and such voluntary changes permitted only if it is going to result in the information, and such information should be reliable and at the same time it shall be relevant. I am disclosing the fact, but it's not going to make any difference in the decision of the investor into my organization. Then such disclosure becomes irrelevant. Then there is no point in disclosing such change in the accounting policy. Further, such disclosure shall be made only when it is reliable, or it has to be made an attempt that it should be more and more reliable so that it can be disclosed. So first thing in regards to accounting policy is it has to be made more reliable and the relevant. Next is we are going to apply changes in accounting policies. So not just change in accounting policy has to be brought into notice by just disclosing it into the notes to accounts, notes to financial statements or reports, but also such changes have to be made applicable into the reports or while preparing the reports. So IFRS requires a change in accounting policy, and that is normally a retrospective effect, and such retrospective effect shall be given by an entity and shall adjust the opening balances of each affected components. Now such components can be equity, they can be any other elements into the capital, any other elements into the assets, wherever it can be. So whatever the changes are there, accordingly such accounting policies have to be changed and such changes have to be made applicable. Most important thing here we saw was changes should be made applicable retrospectively, right? That is, right from the beginning it shall be assumed that we are adopting the policies that are mentioned in IFRS. Further, there are some limitations into this retrospective application, because it may happen that, just to take an example, I purchased an asset on which depreciation that I charged earlier with the help of various accounting standard that were applicable to me as per by country norms or the whatever regulating authority was something different, but today IFRS is saying something different. So whatever such retrospective applications are there, they few times give some limitations, and these limitations stop me or doesn't allow me to give a proper effect, and the cumulative effect may not be always correct. So from this point of view, I may have some limitations, but I can find out some way out, and with the help of such additional benefits that I get, then instead of giving the effects of such IFRS right from the start, with the help of the additional benefit that I am going to receive, I can give the effects of such IFRS that I am going to adopt or that I am adopting right now, for which I am undertaking an activity of retrospective effect, can be made from an particular time period which may be called as an zero period time. Like we'll consider that particular time as a base, and from that point onwards we will consider as we have adopted such IFRS, and from that particular point we can make IFRS applicable and we can implement into our entity. Next, we can go on to the changes in accounting estimates. So as like in accounting policies, we can change accounting estimates as well. So requirements here, except to that the extent the change in the accounting estimates give rise to change in the assets or the liabilities, or relates to any item into the equity. I repeat, accounting estimates are the same as that were mentioned in the GAAP, that is generally accepted accounting principles, except when they are in relation to the changes in assets, liabilities and any item of equity. So estimates are not same in these three cases, otherwise it is absolutely same. Then it shall be recognized by adjusting the carrying amount of the related assets, liability, equity item for the period of change. So accordingly, such changes in the estimates have to be made. Further, prior period errors. It may happen that sometimes we have made some errors and we didn't realize that time. So these errors can be now corrected. These errors can be anything. It's like it can be just like as an omission. One of the asset was simply omitted and was not recorded into the books of accounts. So likewise, any omission error can also be corrected. And in this scenario, the entity's financial statement for one or more prior period may be failing reporting such elements which occurred due to omission, error of omission. Then in this scenario, it is very much important that we find out such prior period errors which may occur due to any type of error, and we inculcate such items into our financial reports, into our books of accounts, into our reporting system, into our audit system, and we will assume that as if it was accounted from that particular point itself, and now when it is available to us with all the details, then we start adopting or implementing such IFRS right from that particular point when we have found out or we have purchased that particular asset, and we could reasonably accept to have an obtained and take into account the preparation and the presentation. And just by taking into account all these elements of the international standards, we have to prepare our financial reports. Just determination of errors does not matter. Along with the determination of error, accounting of errors also matters a lot. So accounting of such errors also needs to be done very much efficiently, and especially it should be accounted carefully when it is going to be in relation to the asset, liability or equity, and it has to mention or it has to give an effect that this is the prior period item and now presented accordingly. So accounting for these errors also play an important role in the adoption of IFRS process. So this is my first item in the IFRS procedure. Let's proceed. Next point is presentation of financial statements. Now first point, we saw how we are going to inculcate the changes in the accounting estimates, accounting policies, and how we are going to apply such changes, and if there are any errors or anything like going to have an retrospective effect, then we are going to account it for accordingly. So all such transactions are going to have an effect on the financial statements, and such financial statements are going to be the final output of such changes, and the significant doubt on the entity's ability to continue as a going concern, the entity should disclose these uncertainties. If the adoption or if the changes are going to make an organization into a doubtful situation, or it's going to be a question mark on their continuity, their going concern aspect, then such entity should be giving an disclosure for this particular uncertainties. Now these uncertainties are included into the presentations of the financial statement under head consistency and presentation. Whether they can consistently continue their organization, then it has to be included here. Further, next category is current and non-current distinction. We can also call it as in current and non-current assets or liabilities or any aspects into the financial reporting. So such current and non-current classification or the distinction simply is there just to give a rigid format, just to have a proper classification broadly, so I can easily distinguish between my assets which I am going to held with me for longer time period, and the other assets then will be held by me for the shorter time period, maybe sometime in days, sometime in months, or some assets may get vanished before the year end itself. So accordingly, just to give a rigid classification base, the financial statements need a distinction between these components on the basis of current and non-current aspect. Next is comprehensive income. What is comprehensive income? Change in the equity during the year may have some transactions which may arise with shareholders and measure some comprehensive income. Also, such comprehensive may not be the total part of profit or loss for the period, or it may be also. So it's like whatever changes are happening, due to that there may be changes in the income. Initially the share held by a particular investor were 10,000, and in this year I as a company has issued 2,000 shares as a bonus. So whatever dividend income that the investor is going to have at the year end, and I as a company, whatever dividend I'm going to pay is going to differ. So accordingly, there is change in the comprehensive income as well. So there is like change in the components here, which is going to be again disclosed and presented along with the financial statements. The third part that is coming under this is property, plant and equipment, which includes component accounting, subsequent accounting, and this subsequent accounting normally includes the further expenses that are included and that are incurred. Sometimes it may happen that there was problem with the recognition principle, and though the nature of the expenditure was capital in nature, but they were not recognized properly, so it might happen that they were recognized as an revenue expenditure. So such subsequent recognition and the expenses also shall be kept into proper consideration and shall be recognized correctly. Then it comes cost measurement. Measurement of the cost, whether at the initial stage or after, shall be done very carefully, may it be in relation to the exchange transaction, may it be in relation to the values that are paid along with the interest, along with the charges or anything else. So this should be kept in mind, first thing. So measurement plays an important role, because if it is in a relation to the loan, we may need to pay an additional expenditure if the loan was not correctly valued and if it was overvalued. And same thing may happen with the help of few items. For instance, if I say I have purchased an asset and no proper cost of such asset was measured correctly, then it may happen that I am losing on the value of depreciation, or I am claiming an additional depreciation. So measurement of cost shall be done very much carefully. Next comes cost of dismantling and removing the item and restoration of sites. So this element includes the initial cost of dismantling and removing the item and restoring the site where the particular business activity is going to get located. So this might be in case only when the activity in the entity is in relation to the site restoration or in relation to the extraction of any coal, mineral, whatever the thing may be. So in that case, it has to be carefully computed regarding to the dismantlation, restoration, etc. activities. Next comes measurement after initial recognition. It may happen that initially entity has chosen a specific method for valuation, but afterwards it found out that other valuation methods can be used, and while the revaluation, it may also happen that the asset or the liability or the any component which is into the consideration is now revalued. So there may be deviation, sometimes there may not be a material deviation as well. So from the current value to the actual value, what is to be intended is an important factor. Further, its useful life, residual life and depreciation method. So in case of these assets, useful life is important, residual value is important, because on basis of both of this, the depreciation method is decided, and on basis of that the depreciation is being charged. And then comes the compensation for impairment. For impairment purpose, there are various provisions into the Indian accounting standards as well. Here also we have, for the purpose of impairment, a special compensation given, and this compensation may be from the third parties, and the laws given or the give up value shall be considered properly while computing profit or loss when such compensation will be received or when it is becoming receivable. So that's it for in the case of property, plant and equipment when it comes into the consideration as a provision of IFRS. Further it is tangible asset, then it comes investment property. An investment property held by an leasee under the operating lease. So it's applicable only when it is under the operating lease arrangement of the business. So it has to be very carefully arranged and it has to be very carefully accounted for when the arrangement is in the case of operating lease. If the recognition of the item in the investment property, then it should be accounted as a lease, as a financial lease. Then it will not remain as an operating lease. I repeat, if any specific activity is not recognized as a normal lease and is recognized as an investment property, then it should be accounted as a lease of the financial lease. Further, measurement principle. Entity should have a proper choice to use the either cost model, and according to this cost model or the value model, the choice is being given to the entity and the investment opportunities can accordingly be taken up by the entity. Next comes the provisions, contingent liabilities and assets. Along with this, we'll cover the fourth point as well, that is intangible assets. So what are intangible assets? Assets with the indefinite useful life, maybe goodwill or any other intangible asset, have the unascertainable life and like they are indefinite. Sometimes it may run for 5, 10, 15 years together, and sometimes maybe due to some mishappenings or anything, it may run just for 2 or 3 months as well. So accordingly, it has an indefinite life, useful life. Along with that, the provisions and the contingent liabilities and the contingent asset are having the similar provisions in case of IFRS. Let's see them. So when it is a provision or a contingent liability or any contingent asset, in that case, 2 points shall be kept into mind. First thing would be an established pattern of past practice and the published policies or the specific current statements. The entity should indicate the other parties that we are going to accept certain responsibilities as in the due course of IFRS they may arise. And the second thing that comes into consideration is, and result of such additional responsibility gets created on the entity and it is a valid expectation of the third party that it shall be discharged, because as it is taken as a responsibility, it has to be discharged by the entity. So if it is any change in the provision or the liability or the current contingent liability or the contingent asset, then it has to be taken care of. May it be in relation to the constructive obligation or may it be in relation to the time value of money. May it be anything. Next come years with us is financial instrument. Now as like as the fixed asset, here we have first point as an initial recognition. This initial recognition itself says that the liability of such asset should be measured in the fair value, and in case of the financial assets and liabilities, it should not be measured at the fair value through the profit and loss, and then it should be added to the fair value of initial measurement. So it should not be measured at the fair value along with the profits and losses is the important point that we should remember. Next point comes subsequent measurement. Now this subsequent measurement is something which occurs when the investments are not secured one, rather not secure, we can say listed one, and they are not recognized by any stock exchange. Subsequent measurement is important in case of private circulation of the funds and hence can be classified as unlisted security or loans and advances. So when it is unlisted security, like it's not recognized by any stock exchange and not listed on any stock exchange, then it amounts to unlisted securities, and loans and advances shall be accordingly measured subsequently in the proper intervals and the gaps. After that, it comes the derecognition of the financial assets. Like sometimes it may happen that risk and rewards of the ownership of such asset may substantially on transfer to the counterparty, or like the entire asset or the part of such asset shall be derecognized. Like I initially owned and big machinery of rupees 5 crores, and now part of it was sold by me for 80 lakhs. Then I need to derecognize that particular financial asset. Now I no more own that asset which was having value of rupees 80 lakhs out of my entire machinery of 5 crores. So along with the recognition, derecognition also plays an important role when we are going to adopt the IFRS. Further, it includes hedge accounting, which we are going to see in detail in the further syllabus. Then it comes the classification of the financial assets, which we have already seen that we are going to classify it broadly as in long term, short term, or the financial asset, or the asset that is held till the maturity time, or the asset which is very much current in the nature, that is like not a long term one, and so on. Then if required, we can also reclassify such assets and instruments. And then subsequently, such a reclassification shall also be measured, and accordingly the liabilities shall also be measured as like as the assets of the organization. Here, let's see the last part, that is the other provisions which are in relation to the leases. There is no major difference between the principles stipulated in the GAAP and IFRS here. Although there is important practical difference that lease of the land shall be excluded from the scope of accounting standard 19 and 17, and now the stipulated international accounting standard which was applicable was 17, and the method that is stipulated in AS 19, that is accounting standard 19, is also adopted here, which was again same in the international accounting standard 17. So this most popular reasons and the application methods are covered under this leases head. Then comes the impairment of assets. So if there is any major difference into the assets which is stipulated in the GAAP and the other IFRS provisions, then such assets shall be impaired. Next is valuation of inventories. So along with this valuation of inventories, there should be no major differences between the principles stipulated in the GAAP, and it should be stipulated in IFRS. So accordingly it has to be taken care of. Further, revenue recognition and construction contracts. or the constructive contracts, which are like in the formation stage, or when we get something into existence which was not there earlier. These elements are also included in this revenue recognition areas. Then comes our important part, that is government grants, the benefits that are provided by the governments to the entities for the specific activity or the single act as well. Then comes the employee benefit. Employee benefit, there is no major difference between the principles which are stipulated in the Indian GAAP and the IFRS again. But the only difference is IFRS is providing the choice to entity to use the approach for the gains and losses. Otherwise, in GAAP, such option was not made available. And last item comes as an income tax. Here income tax has to be adopted and the balance sheet approach has to be taken up. However, in the most situation, result obtained by applying such principles will be the same which are obtained by applying the stipulated GAAP, Indian GAAP. So there are no major changes in GAAP and IFRS, and obviously with the accounting standards which are followed in the India, which are issued by Institute of Chartered Accountants of India, all are quite similar. Hence, these are the elements where we are going to consider the application of IFRS. So that's it for the day. In case of any queries, any doubts, you can reach me, and hope you have understood the basic and entire part of the IFRS. Next time, we'll deal with the next part of the syllabus, which is going to include section 49 of the listing agreement, which is very important topic again as like as IFRS. Thank you.